thank you everyone for joining us today. So as Amy mentioned, I'm Kim Henrichsen. I'm a partner in charge of our exempt organization tax practice here at Eide Bailey, and I'm joined today by Christine Perez. Christine's a senior manager that's part of our exempt organization tax practice. Both Christine and I have the pleasure of being able to work in our national tax office and work with our nonprofit, our governmental, our tax exempt entities on a full-time basis, providing consulting services, compliance services, and these types of educational webinars. So thank you for joining us today for the first in our spring webinar series geared at higher education institutions, and really looking at types of accounting issues that are important to higher education institutions, and starting that out today with tax issues. So we're going to talk kind of a plethora of different ideas. So we'll start out by talking through some current IRS issues, some industry trends that we're seeing with respect to the exempt organization world. We're going to talk about some new energy credits. So some things that have come into play for governmental and nonprofit organizations, and things that we think might be of interest to your institutions. Christine will jump back in on some unrelated business income topics. And then we're going to wrap up with name, image, and likeness agreements. I'm sure everyone is aware of those, but we want to talk through that from a tax standpoint, some of the things that we're seeing, some of the things to keep in mind. So with that, I'm going to turn it over to Christine.
Thanks, Kim. All right, as Kim mentioned, we are going to just run through a couple of IRS and just industry in general updates. But I think most of us are, pretty familiar right now with the IRS and kind of their status as they're still working on a lot of their backlog. A lot of the IRS updates kind of indicate that they are slowly catching up on that backlog, but when we see items that are going in, as correspondence or that are paper filed or things like that, we are still seeing quite the delay. The IRS has also admitted several times, just when we kind of see these IRS updates, that there are still issues with calling in and getting assistance through their phone lines. And then part of that to maybe resolve the issue is, they do have the electronic filing mandates for the 990 series returns. A lot of times we are telling taxpayers to go ahead and utilize the e-file assistance desk instead of calling the IRS main lines directly for nonprofits. And the IRS annually releases a priority guidance plan. And, a lot of times they do kind of move items from one year to the next. As noted here, we've got a couple of carryover items that the IRS still kind of has on their radar. So we're expecting that eventually we will see some group exemption rulings, some supporting organization regulations, and we are still waiting for the IRS to come out with some allocation rules for our siloing and our UBI, or unrelated business income expenditures under Section 512. One item of interest that the IRS did was last year, in the prior years, they had one kind of line item on the priority guidance plan for donor advised fund regulations. And then this year it was split into 4 different pieces. So, that's one area that we've seen the IRS kind of be pretty interested in, are those donor advised funds with respect to our donors and the contributions that come in. And here we've got just kind of a good listing of some recent and historical areas that the IRS and also Congress have been very interested in for higher education organizations. So of course, topping our list is unrelated business income tax, or UBIT, and really the IRS just in general kind of looking for that underreporting of UBI, underreporting of taxes for higher education institutions. And then also they like to typically look, if they were to review a Form 990 series return, or information from an organization compensation. So very interested in making sure that employees and independent contractors are reported correctly, that payroll reporting is correct. And then of interest in recent years, we've had those Section 4960 regulations come out with the 21% excise tax on excess compensation. So we know that that's an item that a lot of organizations are dealing with, especially when we have some of those higher paid individuals that exceed $1 million in compensation. The IRS a couple of years ago released the Section 4968 regulations for the 1.4% excise tax on the net investment income of certain private colleges and universities. That was an item that, kind of maybe was restricted down by the time that the final regulations came out, and it doesn't impact as many organizations as it was originally maybe intended to. And then we've got a lot of IRS focus recently on conversions. So if we have a university or college that changes from a for-profit to an exempt organization, that's an area of IRS interest. And then, of course, we've got a lot of congressional interest and outside party interest on what's happening with payments to coaches in college sports, and making sure that our higher ed organizations are doing everything in maintaining exempt tax purpose under Section 501c3.
Yeah, Christine, I just want to jump in quickly on the 4960, the excise tax. For those of you who are aware of that, that's the excise tax that's on compensation paid to any of your top individuals over $1 million. And obviously, a lot of those individuals are in your athletics department. So a lot of times those are the coaches, the deans, the people that are involved. And, there's a lot of questions going on right now of, how, if you're an exempt organization, how is paying that much to a coach or someone else furthering your tax exempt purpose? There's also some discussion right now because the way the rules are written, depending if you're a state institution, some state institutions are subject to these rules and some state institutions are not, depending on the way that your institution is structured. So there's some disconnect between, some colleges and universities are being subject to this tax and others are not. So, I think there will continue to be push in this area to get some parity and change that definition so that all state institutions are subject to that tax. So I'm anticipating some change in that in the near future.
Yes, we'll see what the IRS comes up with since they've been a little slow lately. I think Kim and I have noted with releasing additional guidance. Kind of one of the other items that's just been on our radar over the past year or so has been the Employee Retention Credit, or the ERC. We've just got a couple slides here that cover just an overview of the differences between the credit and how to claim from one year to the next. I think a lot of our organizations listening today will note that if you're a state college or university, the governmental instrumentalities were not necessarily eligible for 2020. But with the rule changes, we did see that open up for 2021. So we wanted to let, kind of everyone know that it is out there potentially looking at the 2021 credit for the ERC. This, of course, is slightly easier for a lot of employers to obtain because not only did the IRS go ahead and kind of open up the employer, the small employer number. It went from 100 in 2020 to 500 in 2021, which allows a lot of additional employers to qualify. But the gross receipts decline rules were also lowered. So in 2020, a lot of organizations had to meet a 50% or greater gross receipts decline in their quarterly receipts for 2021 versus 2019 as the base year. for 2021, it is only a 20% or greater decline in a quarter's receipts. So 2021 kind of all around, they definitely opened this up for more organizations to be able to kind of review and determine and claim eligibility for this credit. We are still seeing these projects come through. So there are still organizations claiming the credit. It is still open for organizations to do this. So we definitely encourage organizations, if you have not looked through your ERC potential eligibility, we definitely recommend that this piece occur because the credits can be substantial.
And just to kind of follow up on that, the one thing that's, you know, probably most critical, or the first step in thinking through that, is your number of employees, because an organization that has over 500 employees is not going to be eligible for this credit. So that's kind of your first step. But if you're one of the institutions that could fall under that, then it does make sense to start thinking through, you know, your gross revenue declines, thinking through whether there was any suspension of business. And, you know, we're more than happy to help organizations kind of work through, is there any potential for that eligibility?
Perfect. And once our organizations do determine eligibility and also submit the ERC, you know, just kind of a note here, we are seeing some IRS delays, of course, in processing the claims. Eventually the checks do come through for those kind of smaller organizations that do claim the ERC credit. But the IRS and also the AICPA have issued for those entities that do determine that they qualify. There are a lot of ERC mills out there. So, you know, just be wary if an outside organization is, you know, kind of contacting you saying, oh, you could definitely claim this credit, we'll file it for you quick and easy. You know, we definitely want all of our organizations to make sure that you yourselves go through, make sure that you determine eligibility, and you utilize a reliable resource for calculating that credit and submitting the forms. Then, you know, one other kind of hot issue that we've seen recently is just the use of virtual currency and digital assets. You know, we've just got a lot of questions that have been coming in from a lot of other nonprofit organizations, including our higher ed clients, and just making sure that everyone is kind of on board, making sure that they understand, you know, should I be accepting cryptocurrency and digital asset types? Can we accept it? How do we do this? So it's just kind of been one of those interesting conversations because, of course, you know, cryptocurrency and digital assets are very volatile. So we are wanting to make sure that when our charities and organizations put these in place, that we've got the appropriate procedures. So a lot of times there are some internal policies, you know, gift acceptance policies and things of that nature that need to be considered. And then also, you know, considering using an outside or third-party platform for donations. A lot of us do not have cryptocurrency expertise. I myself, you know, do not. I should not be on a trading platform trading crypto. But there are a lot of third-party organizations out there that are assisting with accepting cryptocurrency, converting it into cash immediately, and then kind of remitting and assisting organizations with taking care of that kind of compliance piece with the reporting. So kind of one of those big reminders is that crypto, of course, is a non-cash asset. So making sure that we are up to speed with any of our large donors, you know, that might come in and, you know, give a donation of a non-cash asset in digital format to maybe our university or college foundations or anything like that. We want to make sure that everyone is comfortable with the 82, 83 reporting requirements, that those need to go out for non-cash donations, and that there's also that requirement if you were to receive a donation of cryptocurrency, even if it is immediately converted to cash, that your donor receive an appraisal. So that's kind of one of those big things when you're chatting with donors, making sure that's done when you see those digital asset types come in.
And now we're going to talk about some new tax legislation with energy credits and deductions. And I will say this is a topic that we typically do not talk about in the exempt organization world, even though obviously ESG type activities are extremely important to nonprofits. Typically, the types of credits and deductions that we're going to talk about here are not things that exempt organizations get to take advantage of. And so there's the new change is that the Congress made some of these things eligible for nonprofit organizations. So I want to just touch quickly on kind of the climate economy. So there are these new incentives that came in place with the Inflation Reduction Act. There's a projection from the Congressional Budget Office that there's about $374 billion of these incentives that could be utilized over the next 10 years. Now, the banking industry is saying, nope, that's way too low. We actually think there's about $800 billion of incentives out there. And so that's great news to everyone on this call, because those incentives are things that your organizations can take advantage of. So the Inflation Reduction Act of 2022 came into play in August of last year. And this was, most of us heard about this initially as the Build Back Better Act. There's a lot of financial incentives and tax credits, rebates, really trying to promote clean energy and green initiatives. So that's the primary thing that is eligible out there for all of this money that we're talking about. And when we think about higher education opportunities, what we're really talking about here and what we're going to focus on are construction projects. So think about the construction that goes on your campus on a regular basis. So you might be building new buildings, you might be building student housing, you might be doing renovations on campus. All of those things have the potential for your organization to get some money in the door. There's also some clean energy investments that maybe you're making investments in solar or in wind or in geothermal. And there's some opportunities for you to get money for those. And then there's some opportunities with respect to electric vehicles. So if you're thinking about your fleet of vehicles, and there's some thought about converting some of those to electrical, there may be some opportunities for you there. So we're going to start out talking about the 179D energy efficient deduction. And the key to think about here is this is a tax deduction. So typically, exempt organizations, governmental units aren't real worried about deductions, because if they don't pay tax, there's no real use for a tax deduction. The big change for 2023 and forward is that this deduction can be utilized not only by the organization, but you can actually transfer this deduction to the designers of your buildings. So there's this benefit that's available because of your building that you can transfer to your designer. And as we think about it, there should be some return for that benefit that's being given to them. So that's a big change that came about. Some of the other changes that make this much more appealing moving forward is these rules have been in place, but prior to 2023, the highest deduction that was available was $1.80 per square foot of energy efficient buildings. That's up to $5 per square foot. So that's a pretty huge jump in the potential deduction that's out there. Other changes is that this is now something that you could do every 4 years. So it used to be, it was kind of a one and done. now you're eligible to take this credit or this deduction every 4 years as you continue to do additional projects. In order to do this allocation, so to allocate the deduction to your designer, there is a letter that has to be done by a professional engineer. The professional engineer needs to certify that that we're meeting energy efficiency guidelines and that the building itself is meeting what guidelines are currently in place. And those current guidelines are dating back to about 2006. So most of the building you're doing probably would meet these guidelines. We do anticipate that those will be updated at some point. So it may be harder to meet this in the future, but it's definitely something that most building that you're doing today will meet these guidelines. So here's an example. If you were doing a campus housing renovation, let's say that you've got a heating system, cooling system, lighting. I'm not going to get into what that actually means because I don't know, but our energy people on our team do know what those things mean. What I can tell you is, in this case, if this was a almost 360,000 square foot building, they would qualify for the $5 per square foot deduction, which is going to lead to a $1.8 million tax deduction that then could be sold to the designer. So you may be thinking, okay, well, that's great, but what's in it for me? Why do I care about that? And here's why it may be important to your organization, is we believe that there's an opportunity here because the designer can't get that deduction without the exempt organization transferring it to them. We feel that there is an opportunity for the exempt organization to monetize that deduction. So this is an example of how that would work. So there's 3 parties required, Eide or another third-party firm that has professional engineers that can do the certification. The designer, and the designer is typically going to be your architect, but it could be an engineer, it could be a general contractor, other subcontractors. It's effectively the individual or the firm that helped to design the energy efficient building. And then the exempt organization or governmental unit. So in this example, if we had 625,000 square feet, $5 per square foot comes to a $3.125 million deduction. At the designer's tax rate, so we're assuming a 35% tax rate, that comes to just a little over $1 million of tax savings. So the thought here is the exempt organization could negotiate for a fee to allocate that tax savings to the designer. So in this model, we just put 250,000. This could be, could go up, it could go down, would be something that would be negotiated. And then there would be the fee to actually do the certification project. And so at the end of the day, the designer is still getting $650,000 tax benefit. The exempt organization is getting $250,000, and the third-party CPA or professional engineer is getting that $187,000. So there's a great opportunity here for all 3 parties to benefit from this deduction, which really is a deduction that's coming from the IRS. The next opportunity we're going to talk about are some clean energy investment tax credits. And these are important for us to think about because you'll see the last 2 words or a couple words here say eligible for direct pay. So typically when we have tax credits, credits can be used to reduce your tax down to 0. But usually they're not a refundable credit. So if you don't have tax, you don't get the benefit. these are new. So these are saying, even if you don't have to pay tax, you can still get these credits. So this opens the door for our exempt organizations and our governmental institutions to be eligible for these credits. And effectively, these credits are a payment for investment in equipment that's going to produce energy from alternative sources. We have listed here the types of equipment that you may be investing in. And this basic credit starts with a 6% credit as a percentage of the cost. There's some wage rules that have to be met that we'll talk about later that gets you an additional 30%. The domestic content is basically saying that the steel, the other types of things that are used as part of the equipment has to be US based. And then if you're in an energy community, there's an additional 10%. So, if you were an organization that's eligible for all of this, this could be up to a 56% credit on the cost to put these types of things in place. So when we talk about direct payment, what does that mean? Well, basically, like I said, it means that you get paid even if you don't have tax. We don't know yet for exempt organizations and governmental entities how that will get paid out, but we anticipate that the entity would need to file a 990T, which is the taxable form, to claim this credit. And then the IRS has 60 days after that date to make the payment to the qualified organization. So it's a pretty quick turnaround to get that paid out to the organization. I mentioned earlier wage rules. Basically, what these wage rules are saying is that you have to be paying a prevailing wage within your community to the individuals who are involved in the project. So the laborers, the mechanics, during the construction or the repair of the facility. And then the last piece here, the other opportunity is, as you're thinking about potentially building your fleet, putting into place, some of these clean vehicles, there may be an opportunity for the higher educational institution to get some credits for the use of these types of vehicles. There's also some credits that are alternative fuel refueling properties in place on your campus. So lots of opportunities out here. I would tell you that we're at the very beginning of understanding what opportunities there are in the higher education space. So think about the stuff that you have going on your campus. Think about the types of buildings you're building, if there are building projects or remodeling projects, or if you're being green and putting in, solar or wind or geothermal. There could definitely be opportunities for you to capitalize on some of these credits and deductions. So with that, we have our second polling question, just asking, do you have a renovation, addition, or building that you're going to place in service in 2023 or later? And I should note that for governmental entities, the 179D was actually available for governmental entities in the past. So that ability to sell that deduction was out there. So if you were not aware of that, if you're a governmental entity and were not aware of that, there is still an opportunity for you to be able to go back to any open years, which would be for 3 years, where you could actually go back and sell that credit or that deduction to your designer. They would have to file amended returns to claim it, but it is something that we have seen organizations do. All right, looks like we've got some entities that'll be placing some stuff in service, but the majority, or 50%, do not have anything moving into the future. And with that, I'll turn it back to Christine.
Yes, so we'll just chat a little bit about unrelated business income compliance, since this is always kind of one of those big areas where the IRS certainly likes to kind of review. And it's one of those areas that is definitely kind of maybe one of the bigger risk areas that we see with entities that have a lot of activities going on and that also tend to have alternative investments. So just kind of quickly, unrelated business income, that is income that is essentially not related to your tax exempt purpose. And most of our higher education institutions, we're looking at that tax exempt purpose to educate, to foster learning. So kind of those different activities that, maybe sometimes deal kind of with the public. Those are where we're going to start saying, is there an unrelated trade or business income? Do we have that revenue stream? So, when we look at the basics, kind of that 3-point test, is it a trade or business? Is it regularly carried on? And then, of course, it's not substantially related to the furtherance of your tax exempt purpose. If the organization does have unrelated business income, Form 990T is filed. That is done on an annual basis to report the UBI and the income from the trade or business activities. The tax paid is done at the corporate or trust rate, depending on how an entity is set up. And then, we kind of have the note here that if you have substantial UBI, it can jeopardize your tax exempt status. So here it's very difficult to say, is there a set percentage? Because there is not. Depending on the entity type and the activities that are performed, the IRS can kind of be kind of all over the spectrum as to what constitutes significant UBI. For one organization, it could be 10% of activities. For another organization, 5% or even less could jeopardize that tax exempt status. So no bright line test there. And then, of course, the 990T is required to be filed even if the Form 990 is filed. So just a really good reminder for our higher education entities, such as those that are state colleges, state universities that might be exempt under Section 115A. Even if the Form 990 is not necessarily required, if you have UBI, the Form 990T is still required to be filed with the IRS and the taxes paid. So this slide highlights just kind of the general exclusions. So this is always really helpful. In general, the IRS is going to exclude interest, dividends, royalties, rents, gains and losses, or the disposition of property. So those capital gains, those are the big kind of areas where we see general IRS exclusion from UBI. However, when we get into the area of rentals, it starts to get a little bit more complex. So, with the rental rules, we're looking at, hey, the IRS has a general exclusion for rental activities. But, if there's that financed property associated with the rental, then we have to start looking and splitting that out, because that could be subject to UBI. If you've got a rental that's maybe mixed use or has service components, again, that would be another case where there's potentially UBI and the exclusion might not apply. However, there is a nice special rule for, real property that has debt financing on it for our educational organizations that are specifically described under 170B1A2. And there are certain affiliated organizations. So if that is the case and that is your exemption type and you have debt finance property that is rented, there's that potential exclusion that could allow it to be exempt from UBI that is specific to our higher ed entities, which is nice. And then kind of a reminder here, a couple of years ago, the IRS put into place the siloing regulations under Section 512. And, at this time, they gave us pretty good guidance on, what to do with revenues. So, when we're looking at our unrelated business income tax on our taxable income, we do have to silo it. So essentially categorizing activities or UBI streams that are the same into their different silos. Each of those will be kind of put separately. And unfortunately, this means that if you have one silo with income, say you've got rental properties that are debt financed sitting in there and they've got income, and then you've got a separate silo from another activity, say advertising, losses or income cannot be offset on those two. So that's an area where we kind of saw a little change a couple of years ago, and it can mean that an entity that previously, always had big losses might actually end up paying UBI because those activities can no longer siloed. And here are some common examples of UBI that we typically see for our higher education entities. And, these kind of come out of, what is the IRS interested in? Where have we seen the IRS provide guidance or case law? And then also just from practice, from, what we tend to see addressed or reviewed during the preparation and review of Form 990 series returns. So a lot of times, again, facility rentals, of course, that are debt financed or would have a service component in there. Fitness and recreation centers. So saying, are these being used by our students, by our staff members, by our faculty, or is the outside public coming in? Do people outside of our campus have the ability to have memberships to our golf courses or our fitness centers? Those are areas of potential UBI. Where we have advertising and exclusive provider arrangements. Do we have our sponsors coming in? Do we have qualified sponsorship arrangements with the people that want to put up signs in our campus or our arenas? Or are they getting, call to action benefits that could potentially trigger UBI in advertising? A lot of times with those pamphlets at football and basketball games and everything that kind of go out, making sure that everything would fit under the qualified sponsorship arrangement, or have we kind of broached advertising here, which would be unrelated business income and potentially require, that reporting and tracking. We also have sales of goods or services to the public. So again, where we've got these facility rentals where we're allowing people to come in and host weddings, and we're providing, catering in our student union buildings or bar services and things of that nature. There's the potential for UBI depending on what is being provided. And then, our bookstores, how easily can the public access, our facilities? Do we have substantial sales to the public, and things of that nature for items that might not be related to our tax exempt purpose. And then, where we have seen the IRS kind of come in and take a look with a lot of our higher education organizations is really where the IRS is looking for underreporting. And so there was kind of, there was a report that was done, and I think that was released maybe in 2008. I mean, it was done a while ago, but, they kind of came in and they said, hey, we're going to do a survey of our higher education organizations. I think they surveyed 400 or sent out surveys to 400 organizations, received back 118 responses, and these were kind of the changes. They saw changes in losses from activities that did not qualify. They kind of looked in and found that there was maybe misallocation, incorrect classification of activities, and then also just not carrying forward or back our NOLs where applicable for our entities. So always kind of a big factor is making sure that we are calculating it correctly, and that our trades or businesses are also assessed annually to make sure that they are or are not UBI. The big area that we typically see it in for a lot of our higher ed entities, of course, is through investments. So typically reported on maybe a partnership, K1, or a PTP, publicly traded partnership. The K1 comes in. the entity or the partnership is required to provide information to the institution via the K-1 and the footnotes. However, we do not see consistent reporting across all K-1s, but that is an area of UBI reporting that we always want to review, is what's on the K-1. Do we have some UBI income reported here? That's kind of one of our big areas that we typically see it. So with that, we'll ask another polling question. Our institution annually reviews activities and revenue streams for UBI. Yes, we do this every year. I'm not sure if we do that or have that, and then not applicable.
And Christine, I'll just make a comment on the investment, the K-1s. You know, what we're looking at for there, where Christine mentioned before that most passive income, interest, dividends, capital gains are going to be excluded. Mm-hmm. To the extent that you're investing in a partnership that has ordinary income, that's really where we're seeing the unrelated business income come through. Is, you know, if that partnership is conducting some kind of a trade or business, then the educational institution has to assess that trade or business and determine if it's UBI, if it's unrelated to, you know, educational purposes. So that's really where we're seeing it. Maybe the partnership has debt financing on some of its investment income that flows through. The other key thing that we're seeing in this area is a lot of these investment partnerships that institutions are getting into are getting into some pretty complex foreign transactions. And when you are the ultimate investor, if you're the partner in the partnership, all of the foreign reporting falls on the partner. And so we need to dig through those K-1s to see what kind of transactions are being reported, because there's significant penalties if the partner doesn't report those transactions correctly. So as your entity is starting to get into more and more alternative investments, just know that this is a really big potential area of exposure, and you need to make sure that someone within the institution is looking at it.
Mm-hmm. I think one of those really big questions that's asked with the K-1s is a lot of times, you know, the reporting can be poor with the K-1s, Kim. And just, you know, the statements at the back. Sometimes we get great statements that really break everything out. And then other times we get, you know, footnotes that have just absolutely nothing for allocating UBI. And it is really important to go in to understand the investment, and, you know, when there is poor reporting or reporting that doesn't really kind of give us an idea of what that underlying investment is in, or if it is UBI, to push back to the investment advisor or the partnership that issued the K-1 to request additional information. So, yep, we like seeing that most are reviewing this each year. So that's a great answer. All right, so now we'll kind of cruise through our last topic here, and we'll just chat a little bit about the name, image, and likeness agreements. This has just been kind of a hot topic. So, you know, here NIL stands for name, image, or likeness. And, you know, just with the rule changes the other year, a student athlete can profit from their NIL now. So as mentioned, prior to 2021, the NCAA did prohibit our student athletes from using their NIL for commercial purposes. So they could only accept their scholarships. They could not go out and accept funds for, you know, posting on Twitter and advertising or taking on contracts. So this year, 2023, will be the third year in which the use of NIL by our student athletes for profit is allowed. So it's really a new area for our student athletes. It's a new area for our universities. And it's a new area for NIL collectives that may have been set up or affiliated with our university and college campuses. You know, most of our students, I would say, you know, are probably going to have some smaller amounts. You most of the NILs are for a variety of sports, men's and women's, but we do have situations where, of course, some of the more prolific players or some of the larger sports that bring in revenues, they are going to see larger contracts for NIL that are put out there for the students. And so, when the students are looking at NIL, there are several tax implications, of course, for our student athletes. So, the receipt of the cash, the non-cash items that our students receive are taxable at the federal, state, and potentially local levels for those students. They are considered independent contractors. So when they are signed up for these NIL deals, they're typically going to receive maybe a 1099 as an independent contractor. They are not considered employees. And of course, when they are acting as the independent contractor, a lot of times, of course, tax is not withheld from the income or the payments that are coming through. So then these students, depending on the amount of these NIL agreements, could have substantial tax that comes due when they go to file their personal returns. So, that's kind of a big area we want our student athletes to consider, quarterly payments, depending on the amounts due. They can offset income with expenditures for those NIL activities. And then, kind of depending on the amount, just being aware that the NIL arrangements or agreements could jeopardize some of their ability for financial aid. And, schools can kind of provide some educational sessions with, the athletes, but there are some limitations, on what services a school could provide with respect to athletes and those NIL agreements or arrangements. So kind of what is the collective? Our collectives, or the NIL collectives that are being set up, they're separate. It's an entity separate from the college or the university. They're typically affiliated, but are separate legal entities. And they are set up essentially to pool the funding. So it'll come in from our alumni, our donors, our community members, anybody that maybe wants to interact or support the student athletes will donate. And these entities, the NIL collectives, are typically they're the entity that will facilitate those NIL arrangements or agreements with the student athletes. And they can also kind of act as an intermediary, is kind of what those entities are doing. And they can be in various forms. So we can see them set up as for-profit entities. So it could be an LLC or, a corporation. And then we can actually also have NIL collectives set up as nonprofit corporations as well. A few general rules when we're thinking about the collectives. The collectives, of course, must, operate under, federal and state tax laws, and they also must operate within the guidance and rules that are established by the NCAA. The NIL collectives, when they're set up, it's such a new area that's where we're kind of seeing that almost hesitancy, or the questions start to be asked, depending on the setup, with what needs to be followed and what can be done at this time. We do know that the NIL collectives cannot be used as a pay-for-play. And so there are rules that have been set up by the NCAA, which prohibit essentially the NIL collectives from being utilized as recruiting or recruitment inducement tools, and forcing an athlete to play for a certain school. So an athlete can go ahead and deal with various collectives. They can deal with collectives from different universities and schools, and do not have to play for that school.
Great. So Christine mentioned, there's really two different types of collectives that are out there. So there's for-profit collectives, there's nonprofit collectives. And currently there's about 200 of these collectives that have been formed nationwide. About a third of them are the nonprofit, about 2/3 are for-profit. And a lot of universities may have both, because you can use them to do different things. So a for-profit collective operates as a normal business. So amounts that are raised are going to go to the athletes to perform certain activities. The for-profit entity is typically going to seek funding, from fans, from alumni, from community members, from businesses that want to engage with the students. Sometimes there's some subscriptions. So, if an individual pays a certain amount, they may get access to special events. They may get some memorabilia or merchandise. The key thing with these types of collectives, the for-profit, is there isn't any kind of charitable contribution deduction. So if an individual gives money to this entity, they don't get to take a charitable contribution. If a business gives money to the collective, they may be able to treat it as a business expense. Maybe it's some kind of a promotional expense. Maybe they're actually paying the student athlete to perform some service, but there's not a deduction allowed along with it, which is why we also have the nonprofit collectives. So in a nonprofit collective, it's typically going to be set up as a nonprofit corporation that's going to seek 501c3 status from the IRS. The benefit of that is fans or individuals who give money to that entity are going to get a charitable contribution deduction. In this case, though, there has to be some kind of charitable intent and charitable nature of the collective in order for it to get this 501c3 tax status. So as mentioned, they do have to get approval from the IRS. They have to operate for an exempt purpose and have a charitable mission. So this might be on, providing education to the athletes. It might be on assisting the athletes to get involved in community organizations. In order to be a 501c3 charity, you're typically going to be a public charity. So there has to be funding from a broad range of donors. It can't just be one or two large donors who are giving money here and thinking that they can maintain this public charity status. The other big difference between a for-profit and a nonprofit is there's restrictions on what a nonprofit can pay. A student can pay anyone for the services they provide. So the amount that's being paid has to be reasonable. So oftentimes what we see in these nonprofit collectives is that the students are getting paid to participate in charitable activities or charitable events. Maybe they're getting paid to volunteer at an organization. And so it raises the question of, well, what's reasonable to pay someone to volunteer at a charity? Most people do that for no pay. So why would someone get paid to do that type of activity? So I think that the nonprofit collectives is probably the area where there's the biggest scrutiny right now and the biggest potential for abuse, because there is this benefit to the donors. And then there's a question of, well, what's the charity piece of it? Just some examples here on some of the things that student athletes might be doing that could fall within a nonprofit collective. Then just as we think about overall some of these considerations, is that collective really necessary to ensure athletic program success? I think there's, definitely some questions around that, but right now it seems like everyone thinks, yes, we have to have a collective. Do the participants, are student athletes looking for this? Are they needing help in getting these NIL agreements? Are there other collectives that are already out there? There's some institutions that have multiple collectives because collectives will get set up for each particular sport. And now all of a sudden you have donors that you're competing for those donors. You're competing for those individuals who are going to pay the collective to help the student athletes. So I think we'll see some restructuring and maybe some limiting of the numbers per entity. If the collective is actually making payments to the student athletes, they have to track those payments. They're going to have to issue the 1099s. They're going to need to make sure that they've got arrangements and agreements in place. So these collectives have to operate like businesses. You can't just, kind of willy-nilly put it together and collect money and start distributing it out to the athletes. The NCAA, the states, local, federal are all going to have guidelines that have to be followed for the collectives. Yes, right here, there's policies and restrictions that are going to be enforced by the NCAA. There's policies and restrictions from certain athletic conferences, and more likely, and there should be, some procedures and policies that are enforced by the college or the university. So there's got to be some connection between the collective and the university to understand, what types of arrangements the collective is helping those student athletes enter into. Making sure that if there is use of logos and trademarks and uniforms, should there be payments to the university for that? What's happening in that realm of the world? So, we highly recommend that these collectives, if you're getting them set up, that they are seeking legal advice, seeking financial advice to make sure they're in compliance with all the different rules that are out there. And we do think the legal and regulatory landscape is going to continue to change. The current NCAA policy was adopted in the interim, which means they still have to bring out formal rules. There's state laws with respect to the NIL collectives. Some states have state laws, some states don't. Some states are trying to figure out if they want to or if they don't want to. In fact, I have a map here of the states that currently have NIL laws or are looking to put laws in place. This is actually as of September of 2021. And even since this, some of these have changed. So some of the ones that are in blue have gone into effect. I would say in general, the ones that are gray, where it says there isn't any state law, those have stayed pretty consistent with the exception of Maine. But as you see, most of the southern states, there are some state laws that have to be followed by these NIL collectives. And then lastly, I think everyone is pushing there's some push for congressional law to kind of enforce national rules around these payments and the collective entities. Given the current regulatory environment, whether that's going to happen anytime soon is probably a question. There was some proposed legislation back in September that would effectively prohibit individuals from getting a charitable contribution deduction. So basically saying these that are set up as 501c3s, either you won't be able to maintain that tax exemption or your donors won't be able to get a charitable contribution deduction. Nothing happened with that, but I think it's good to know that that is out there, and there is definitely consideration on, is there really charitable intent with these collectives? So with that, we appreciate you sticking with us for a couple extra minutes here. We have our last polling question. Do student athletes attending your institution participate in NIL arrangements? So we'll let you finish that up, and we will open this up for questions at the end if anyone has questions. But I do want to thank everyone for participating with us today. We really appreciate your time, and we hope that you will join us for the next in our webinar series. We've got one on March 23rd that's called Documenting Key Accounting Processes, your GPS when the road gets rough, and on April 5th for federal compliance considerations.